Welcome to Spreadsheet Geek. In this video, we'll talk bonds. We'll cover how to value a series of future cash flows like you would receive if you owned a bond. Then we'll cover the concept of duration, what it means, how it's used, and how it can be calculated using Excel functions. This video was made using Microsoft Excel 2019. Let's cover some basic bond terminology first. Every bond has an issuer. It could be a government, a publicly traded company, or a private company. Different issuers of bonds have different abilities to pay back debt, so they have different credit ratings. Bonds have a face value, which indicates the type of currency the bond is denominated in, and it's usually a nice round number. The most common denomination for bonds in the U.S. is $1,000. Most bonds have a coupon rate. The coupon rate is normally printed on the bond, and it's an annual interest rate on the face value. This bond pays 5% interest on a $1,000 face value, or $50 per year. There are some variable rate bonds that don't have a fixed coupon rate. Along with the coupon rate comes coupon dates. These are the dates on which interest is paid to the bondholder. In this example, a coupon date occurs every 6 months for the term of the bond, and that's a very typical arrangement. In the old days, a bondholder would actually separate one of his coupons every 6 months and go to the bank to redeem his interest. This is no longer done today, as many bonds are electronic. The U.S. government stopped printing most bonds in 2012. Unless it's a perpetual bond, all bonds have a maturity date. In the example I've shown here, this is the date that last interest payment of $25 would be paid, as well as the face value amount. For printed bonds, an issue date is often added sometime after the bond is printed. The issue date is the date on which the bond starts to accrue interest. In this example, I've chosen a very convenient issue date, which is exactly 5 years prior to the maturity date, but this is not always the case. This bond could have been issued 4 years and 11 months prior to its maturity date, and in that case, the bondholder would receive something less than $25 on his first coupon date. The issue price is the price the bond buyer agrees to. It could theoretically be the face value of the bond, but usually it's not. Sometimes bonds are sold with fixed prices, and sometimes their prices are allowed to float freely in a bond auction. The issue price of a bond most often depends on the current interest rate environment and the credit quality of the issuer. So what are you buying when you buy a bond? Let's map out the future cash flows of our bond on a 5-year timeline. This is what the interest payments would look like. And here I've added that final large payment of face value at the 5-year mark. This is what you're buying when you're purchasing this type of bond. What is this series of cash flows worth at time 0? Putting a value on this bond involves 2 steps. 1, pick a discount rate that's appropriate for the credit quality of the debtor. And 2, discount all of these cash flows to present value using that discount rate. I'm going to choose a discount rate of 5%, but don't confuse that with the coupon rate. The two are not directly related. Now that I've picked a discount rate, I need to discount my future cash flows. And I've just mapped them out here in Excel. So every 6 months, we get another $25 cash flow, and at the end of 5 years, we get $25 plus the $1,000. That's our map, and we're going to use the net present value function of Excel to compute a present value. We'll use the net present value function. The first argument is a rate. Now remember, if our annual rate is 5%, our 6-month rate is 2.5%. And with the net present value function, as long as your cash flows are evenly spaced, which is every 6 months, you can just copy those into the formula. This net present value function does not work for unevenly spaced cash flows in the future. You have to discount those separately. So that method yields a bond value at time zero of $1,000, and that makes perfect sense. The coupon rate was 5%. If we discounted it at 5%, we're going to get right back to the face value of $1,000. But issue price has little to do with face value. Let's try some other discount rates. Let's say this debtor has a better credit rating, and we should only discount his debt at 4%. How will that affect the bond's value? Half of 4% is 2%, and we'll copy in the cash flows. It's a little more expensive. And what if this debtor had poor credit rating and he deserved to have his cash flows discounted at 6%? As you would probably expect, this borrower is going to receive less cash from us in that case because he is a riskier prospect. There's one more very important thing to mention about bonds, and it's the thing that most people are focused on when they purchase a bond, and that's the bond yield. If you take the coupon payments for 1 year and divide by the purchase price of the bond, you get to the bond yield. In this case, bond issuer with the lower credit rating and more questionable ability to pay back his debt will yield higher than the higher credit quality bond issuer. Don't confuse this simple yield with another term called yield to maturity. I'm not going to cover yield to maturity in this video because it's a fairly complex calculation. Yield to maturity is the yield a bond investor would receive if he holds the bond all the way to maturity and he reinvests each of these cash flows at the bond's current yield. It's kind of a theoretical measure of yield. It rarely plays out in fruition because interest rates will change over the time horizon of the bond. Maybe that's a topic for a future video. That's all I'm going to talk about with bond terminology and valuation. Let's move on to bond duration. Duration is a concept introduced by Canadian economist Frederick Macaulay in about 1938. There are many kinds of duration, but there are two that are very commonly referenced. Unfortunately, there is some confusion with these terms. The one on the left, Macaulay duration, is calculated using the Excel duration function. Sometimes in some references I've simply seen this one called duration without the Macaulay. The other type on the right is modified duration, and this is calculated using Excel's MDURATION function. I have seen this in at least one source referred to as Macaulay modified duration, if that's not confusing enough. But if you see the word modified duration, you probably want to use the MDURATION function. Let's talk about Macaulay duration first. Macaulay duration was created to help assess interest rate risk. Interest rate risk, stated simply, is the potential for investment losses that result from a change in interest rates. Usually that means rates have moved higher since you purchased your bond. Imagine you bought that 5% yielding bond. And imagine after 2 years you wanted to liquidate it. But during that 2-year period of time, yields on similar debt have risen to 6%. You'd be forced to compete with all those new 6% yielders, and you'd have to discount the debt you hold appropriately. Now imagine a different scenario. You bought that 5% yielding bond and you held it to 4.5 years. Now what is your bond worth on the market? Well, an interesting thing happens that as we come toward the end of the term of a bond, the price of that bond on the open market rapidly converges with the last cash flow, which in this case would be $1,025. And on the last day of the term of the bond, it's worth exactly that. So at the end of a bond's term, interest rate risk becomes less and less relevant. The most commonly stated definition of Macaulay duration is that it's the weighted average of times until cash flows are received. And those cash flows are weighted by the dollar size that they are. This is true, but I like another definition I saw in one source a lot better. Under this alternate definition, Macaulay duration is the holding period at the end of which the holder of the bond is no longer affected by interest rate risk. This alternate definition gets to the heart of what Macaulay duration is intended to indicate. Macaulay duration is really easier to visualize than it is to define verbally. We've all seen a playground seesaw. If these were weights on a playground seesaw, where would you place the fulcrum to balance the load? You might place it here, where that heavy kid on the right will be offset by a bunch of little kids on the left. That point on the timeline where we place the fulcrum to balance this seesaw is the weighted average of times until cash flows are received. To calculate duration in Excel, you use the duration function, and you'll need to lay out some information like I have here. The settlement date must be entered in a date format that Excel can recognize as a date. Likewise, the maturity date. The percent coupon is the coupon rate on the face of the bond. The yield is the yield at the time you purchase the bond. Frequency can be a 1, 2, or a 4, depending on whether coupon dates come once a year, twice a year, or quarterly. In our case, we have 2 per year. And the actual divided by actual basis has to do with accounting. Some accounting systems treat every year as if it had 360 days, and banks sometimes do this, and sometimes they treat every month as if it had only 30 days. But if you use a 1 for that argument, you will use the actual day count that's involved, and that'll work fine for us. So we'll just plug in the duration function, and all you have to do is go right down the line here. And this last argument, basis, is actually an optional argument, so I'll add it in. And we get to a Macaulay duration of 4.48 years. And that's about where we positioned our fulcrum to balance our seesaw. So after 4.48 years, interest rate risk is really no longer relevant because those final cash flows are right around the corner. Let's change some of the parameters of our bond and see how the Macaulay duration is impacted. So with a 5-year bond, the Macaulay duration is about 4.5 years, or about 90% of the term. What if I change this to a 12-year bond? We'll make it due in 2032. Now that you see an interesting thing happens, where we had about 90% of the time with the 5-year bond, now we've only got about 75%. And if I change this to a 20-year bond, look what happens now. We're only a little past 12 or approaching 13 years on our timeline, and it's saying that interest rate risk is no longer relevant. This is where that alternate definition may fall apart a little bit with long bonds, and let's just change this to a 30-year bond and see where it falls out. Now we're only, just a little past halfway on a 30-year bond. I'm not sure I buy that interest rate risk is no longer relevant when you've got nearly 14 years to go till the bond comes due. So that Macaulay duration definition probably only works for short-term bonds of 5 years or less, or mid-term bonds, which are generally considered 5 to 12-year terms. When you start getting into long bonds that are 12 years to maturity or more, it may not hold up as well. Now let's put that maturity date back where it was in 2025. We're back to our 5-year bond, and I'm just going to change the coupon rate to 8%. Notice how that drops the Macaulay duration, and that's in keeping with our seesaw model. Each of our coupon payments grew a little, so we have more weight on the left side of the seesaw, so our fulcrum shifted to the left a little. Macaulay duration is always less than maturity, except for one kind of bond, the zero coupon bond, in which there are no coupon dates. With a zero coupon bond, all interest and the face value are received at the end of the timeline, so maturity equals duration for that kind of bond. The final topic of this video is modified duration. You have to calculate Macaulay duration before you can get to modified duration, but Excel does it all for us with the MDURATION function. Modified duration is a measure of the change in the value of a bond in response to a change of 100 basis points in interest rates. Modified duration measures the sensitivity of our bond's value in response to a change in interest rates. As covered earlier, as we get close to the maturity of the bond's value becomes less and less sensitive to changes in interest rates. We're back to that same 5-year bond we've been using as an example. The arguments are identical to duration with the MDURATION function. Let's enter it in. So MDURATION or modified duration for this bond is 4.37 years. That's a little less than the Macaulay duration, which was 4.48 years, and that is always going to be the case. Modified duration will be a little less than Macaulay duration. So what does this 4.37 mean? Well, if prevailing interest rates were to go up by 1% or 100 basis points, you should expect the market value of this bond to drop by 4.37%. Likewise, if interest rates were to fall by 1%, you would expect an increase in the value of this bond by 4.37%. Let's see what happens when we change this to a 12-year bond. You can see that the 12-year bond is much more sensitive to a change in interest rates, and just for the heck of it, let's look at that 50 or 30-year bond coming due in 2050. You can see that that is very sensitive to interest rate changes. This is why people get hurt when they invest a lot of money or too much money in long bonds. Imagine investing in long bonds and then experiencing an interest rate increase of, say, 3%, which would wipe out 45% of your bond's value until you get toward maturity, but that's a very long time into the future. This video's gone a little longer than I expected. If you are curious about how these things work, I recommend you load up these functions, MDURATION and Macaulay duration, and just experiment with different maturities, coupon rates, and yields, and you can get a feel for which direction things move with changes. I hope you found this video useful and informative and would like to see more of them. Please give me a thumbs up and consider subscribing if you're so inclined. I'll be releasing a new video at least once a week for the foreseeable future. Thanks for visiting Spreadsheet Geek.